What's up, money lovers? Welcome back. So this is going to be our first episode of a new series called Invest Like the Best, where we're going to teach you guys how to invest like some of the greatest investors of all time. We're going to start with Peter Lynch. Now, if you haven't heard of Peter Lynch, one of the greatest investors of all time, Peter Lynch was the manager of the Magellan Fund at Fidelity Investments, and from 1977 to 1990, he averaged a 29.2% annual return, consistently more than double the S&P 500 stock market index and making it the best performing mutual fund in the world. Not a bad track record. So he definitely knows a thing or two about investing. So I just picked up a fantastic book that I read a couple years back, and I wanted to take a second deeper dive into it. The book is One Up on Wall Street by Peter Lynch. So today I just wanted to go over a few of my initial takeaways, and if you guys enjoy this, I will continue making these videos on some other great points he makes in the book. So here we go. Things Lynch talked about that stood out to me was the importance of paying attention to the earnings of a company rather than its stock price. So here we've got a chart of Amazon's revenue from 2006 to 2020. As you can see here, each year their revenue keeps increasing consistently. So back in around 2010, they're making maybe 30 billion. Fast forward to 2016, they're up to 113 billion. And 2020 here, they're bringing in almost 400 billion in revenue. So Lynch says, you need to follow companies' earnings, not stock price. We tend to obsessively check stock price every day. It doesn't matter what a stock price is today, tomorrow, next week. It literally is so meaningless. It is only a distraction. The stock price will eventually follow the earnings. So if you're a long-term investor, don't even look at the stock price. Maybe check it once every 6 months. He also says why you shouldn't buy into a company's future earnings. So a newly IPO'd company, a company that hasn't proven itself yet, that says it's going to have 100 million in revenue over the next 5 years. Anything can happen. You're better off waiting, seeing how it actually plays out, and then investing when the company has proved itself. Yeah, you're going to lower your returns, but you're also going to significantly lower your risk. When Lynch picked, his big winners, he'd give them a 3 to 10 year time horizon. So he wasn't expecting big gains overnight, next month, or even in a year. He was looking for what they were going to be accomplishing 3 to 10 years out. And if you're a long-term investor, that's the same type of mindset you should have, maybe even a longer horizon. Now, there's many advantages you, the retail investor, have over Wall Street, and many ways you can use these strengths to help you make better investments. Simply by paying attention, whether you're at the workplace, the supermarket, shopping, the cars you see while you're driving, paying attention to products maybe that you see that are hot, that are out of stock, stores you see that they're always packed, have long lines. One that comes to mind for me is TJ Maxx. I love shopping there. Always go in needing nothing, spend $200, fantastic business model, and the line is always so long. However, take it with a grain of salt, because you shouldn't buy something just because you like it or just because the store looks busy. Use this only as your starting point, like the first clue in your investigation. So use that as a stepping stone, and from there you're going to jump off into finding out what our company's earnings look like. What are the company's prospects? What are their financial conditions? Do they have a lot of debt? What's their competitive position? And do they have any plans for expansion? For example, specifically, you can apply this to retail, but a lot of other industries as well. Has the company established itself in 10% of the market or 10% of the country versus has it established itself in 90% of the country? Obviously, if a store has a footprint in 90% of the country already, it has a lot less room to grow than a company that's only in 10%, or maybe it's only in one state so far. So that's another thing you can look at to get an idea of a company's future growth prospects. Another point he makes that I really liked was, he says that the bearish argument always sounds intelligent. Every day you wake up, you turn the news on, the world is ending, the market is crashing, stocks are overvalued. If you let the news influence you heavily and you watch it every day, it's going to make you make bad decisions, and it's constantly going to be pressuring you into thinking, oh, I should be selling all my stocks, the market's overvalued, there's going to be a crash. It's all nonsense. Even when people say the market is overvalued, yes, stocks can be overvalued, but you shouldn't worry about it at all. You know why? Let's look at a chart of the S&P 500. Over the long run, you could say the S&P 500 has been overvalued every single year, and guess what? It goes higher the next year. You may not know what happens month to month or year to year, but if you're looking 5 years out, 10 years out, you can bet that the market is going to be higher than it was. They've been saying that stocks are overpriced since the dawn of time, and yet the Dow, S&P just continue to hit record high after record high after record high. So there's no point in worrying about an overvalued market. With that being said, should you dump all your money into speculative companies when they're at their height? Probably not. But the way around this is just to consistently have a plan. dollar cost average, allot yourself a specific amount. You're going to invest monthly, annually, what have you, and just stick to it. So let me know if you guys enjoyed this video, if you learned something today. Don't forget to like and subscribe. It really helps out the channel. And if you want to see more of this, let me know in the comments below. I have a lot more to talk about in this book, and there's so many other great investors out there to cover. So with that being said, that's all for today. This is Vinny from the Investment Club, and I'll see you next time.